Good morning, everybody. Hopefully you had a wonderful weekend. We have kind of a fun, interactive call today that I think when we get to the main topic that we can all learn from, and I think it's going to be a good tool for you to use with your clients and even your prospects. But before that, I want to go through some pointers here that we can talk about. First is the breakdown from last week. Ever get a client who says okay when you ask them an open-ended question? Here's how you deal with it. Because if they say okay, or they say yeah, or they say uh-huh, what's that worth, guys? Okay, yeah, or uh-huh. What's that worth? That's worth nothing. That's right. It's worth zero. They have to give you a complete thought answer, because yes means nothing, or it means all sorts of different things that we don't know what the actual meaning is. So here's how you deal with it when they do that. So if you haven't looked at that, you don't know how to do that, make sure you go back and listen to that tape breakdown. So I apologize. I'm going to go through quite a bit of reading here from an article. I summarized it. I mean, it's only about 10% of the total article, but I think it's important for us to understand what's going on. The modern world has finally become too complex for any of us to understand. Vast systems from automated supply chains to high-frequency trading now undergird our daily lives, and we're losing control of all of them. So how did, for example, how did the automated supply chains, how did that affect us over the last year? Where did that affect us this year? Anybody worry about where they're going to get their toilet paper earlier this year? Yeah, that's right, David. No toilet paper. So when you have these automated supply chains that are really, they only send, they don't have anything in the warehouse, or they have very little in the warehouse, they only make it on demand. If there's any little tiny hiccup, what can happen? So here's just 10% of the article, but I think it's important you understand this. I'm here to tell you that the reason so much of the world seems incomprehensible is that it is incomprehensible. From social media to the global economy to supply chains, our lives rest precariously on systems that have become so complex. We have yielded so much of its technologies and autonomous actors that no one totally comprehends it all. Most of us do not spend a lot of time thinking about the huge complex systems that keep our technologically dependent society running. And with very good reason. It takes a certain amount of faith and belief in ourselves and capitalism and the digital platforms that mediate interactions with it, and in the infrastructures that support all of the above in order to wake up and get through every day. I mean, guys, think about all the stuff that happens. Do we know how they make, do we know all the, from beginning to end, what it takes to make a roll of toilet paper? We're in the financial industry. Do we even know with all of the trading systems that are going on today, do we even know how a trade is made anymore? Or is it all basically black box things that are occurring all around us, whether it's toilet paper or our 401ks? We're surrounded by black boxes. But eating breakfast, pulling on your business casual, Zoom appropriate shirts, all of these mundane acts are made possible by an almost unfathomably complex, algorithmically calibrated, partly automated, partly sweatshop labor dependent global supply chain. Just as vast and complex and intrinsically linked to the supply chain is another sprawling but mostly invisible system, the global financial markets. It's a vast, highly technologized network linking banks, government agencies, hedge funds, regulatory bodies, stock markets, dark pools, exchanges, news services, and millions of individual human traders and analysts. It has grown to a level of complexity that makes it unknowable by any single human intelligence. Everything moves at too great a speed and scale. So what we've ended up with is a civilization built on a constant flow of physical goods, capital, and data, and networks we've built to manage these flows in the most efficient ways possible, but they become so vast and complex that now they're beyond the scale of any single and arguably any group or team of human understanding them. It's tempting to think of these networks as huge organisms with tentacles spanning the globe that touch and everything interlinked with one another, but I'm not sure the metaphor is apt. An organism suggested some form of centralized intelligence, a nervous system with a brain at its center, processing data through feedback loops and making decisions. But the reality is, with these networks around the world right now, these networks are much closer to the concept of distributed intelligence or distributed knowledge, where many different agents with limited information That means everybody's working behind curtains and don't know what the other person's doing beyond their immediate environment, interact in ways that lead to decision making, often without them even knowing what they're doing. Guys, do you remember, and this is 20 years ago. This is 20 years ago. Do you remember the 300-year-old bank in England that went bankrupt? Do you remember the 300-year-old bank in England that went bankrupt about 20 years ago? What was the name of that bank? Does anybody remember? Barings. That's right, Mark. And Mark, why did it go bankrupt? Remember? Yeah, a 30-year-old kid, Dale, was making trades. And his management didn't even know he was doing this. And he was making money hand over fist, fist over hand until it didn't work, and then it blew up a 300-year-old bank. And is the world more or less complicated? That's just one bank in a world that was more or less complicated 20 years ago. So can you imagine what's going on today? Firstly, and most obviously, parts of all these systems can simply fail. As we all know, the more complicated something is, the more ways something can go wrong. We've had a few opportunities recently to see examples of this happening. Just this year, we've watched the supply chain struggle under COVID, leading shortages and misallocations, everything from protective masks to flour to toilet paper. The fallout from COVID has been even more devastating effect on the global economy, although we've seen the markets come close to collapse without the help of a global disaster, such as during 2008 financial crisis. And the internet is certainly prone to failures, perhaps most starkly illustrated by the WannaCry ransom attack of 2017, which is said to have affected more than 200,000 computers across the 150 countries, costing billions of dollars worth of damage and lost earnings. So how many of you knew about this WannaCry ransomware attack from 2017? So Nick did. How many of your clients do you think knew about that? One example I give of this is that the whole Western United States almost lost power. The whole Western United States almost lost power. It came within one circuit breaker, and a lot of people scratched their heads. A lot of experts scratched their heads on why this did not happen. It was pure luck. The whole Western United States almost lost power, and it was about 15 years ago. And why was that, guys? Does anybody remember why that was? Some Yahoo with his gun shot out a transformer, one transformer, and it went right down the line, pop, 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 made it all the way to one circuit breaker before the whole, basically from the Rockies to the West Coast, went out. So should we have and do you think that our power supply system, when they saw that, do you think they then said, oh, we should really bolster our power system? Yeah, the grid is ancient. You're exactly right, Mark. The grid is ancient. Well, David said, of course they did. No, they didn't. You'd think, David, you're right. They should have, but they didn't. How many billions of dollars will it take to make? That's right. It's too expensive. They view it as too expensive. It's just like our bridges, right? That's right. It's just like our bridges. It's our infrastructure system. They haven't made the bolster it. Also, China, Russia, Iran. Could they go into our power, go into the computer systems and tank our power? There's proof that they could actually do that. Heck, did you see this weekend? Two of our most important departments, U.S. government departments, were hacked, and they'd been hacked for 6 months or more. Now, the only thing that's keeping them from doing that is that we will what? If they do that to us, we're going to respond to that. But if a company gets desperate, if a country gets desperate, there are countries that already could tank our power grid system. What would that do to our economy if our power system was compromised? Yeah, done. So back here. So interestingly, one of the industries hit hardest by malware attacks that year was shipping, with them crippling parts of supply chains. The companies like Maersk, which is a shipping company, was forced to watch their networks grind to a halt. What's worrying is that while none of these catastrophic failures and networks eventually recovered, it took, in some cases, years of expert analysis and debate to work out what actually went wrong, exactly because how complex these systems were to understand. It took years of experts to figure out what went wrong. And can you fix anything until you understand what went wrong? Seeding control to a very vast. I'm just going to skip to the end here. But what do you think the point I'm making? What do you think the point I'm making here is? Why, as financial advisors on a coaching call on Monday, why am I pointing this data out to you? Risk. That's right, Bob. Risk, risk, risk. And Mark, thanks for sending me this article here. Flood of day traders strains online brokers, and the backlash is swift. Interactive brokers and rivals conclude Charles Schwab Corp and Morgan Stanley E-Trade have set records this year for customer accounts and activity by day traders. Many of them stuck at home with a few distractions have ridden with more than 60% surge since March lows. But that's brought a greater focus on how companies operate in serving their growing legions of customers. So now we have what? When you got a whole bunch of day traders at home, has that made the financial system more or less complex? Because we've talked about this. Our most of the activity that's occurred in this year, has it been by institutional investors or by these guys at home? Where's most of the activity been? Yeah, the big guys are where now? In the market or sitting on the sidelines? Yeah, they're in cash, right, David? They're in cash, Dale. They're in cash, John. So this is something we need to be aware of. One of the funny things about the stock market is that every time one person buys, another sells, and both think they're what? Every time somebody, in order for a trade to occur, that's right, Tom, they both think they're right. So that means you got what kind of a chance of being right? Every time you sell, you got what chance of being right? 50-50. Yep, 50-50. And again, I keep showing you this because this has been the unbelievable indicator. Shiller PE, where are we right now? There was September 1st, 2005. Look at where we are right now. And that means that right now where we're at, going forward, and again, this isn't going all the way back. If we went all the way back to 1900, using that data, we should expect a negative return for the next 10 years if we went all the way back to 1900. So there's another thought with the Shiller that we only go back 25 years. And when we go back 25 years, and even the average, we're looking at a 1.1% rate of return over the next 10 years. 1.1 rate of return for the next 10 years. How many of your clients are going to be happy with their stocks and the risk that's entailed with a 1.1% rate of return? The only difference could be is we have some sort of technology like the internet that would create an unbelievable blast of growth in the world economy. Now, maybe we can get that with biotech. Maybe we can get that with cryptocurrency. Maybe we can get that with solar, or not solar, but renewable energy. That's a possibility. But how long does it take for those things to really go? It takes a long time. A long time. So my point is this, and I've talked about this a lot here back 3 or 4 years ago, but we need to be reminded, right now, we're in a room full of combustible material, all sorts of combustible material with a can of gasoline. Just because you walk into this room, is it going to start on fire? Because it has all this combustible material and a can of gasoline. Does that mean it's going to just go up? No. But would you want this room on the back attached to the back of your house? Yeah, because what would it take to make this thing go up? Because if this was a clean room, no combustible material, all cement and a can of gasoline, it would take what to get that room up in flames? A lot. But right now, with the complexity of the world, with the kind of trading that's going on in the world, with as high as the market is right now, it's not going to take much to make that go up. So again, that's the reason we preach what? 50-50, 50-50, 50-50. Should you have more than 50% of the money in the market right now? Because what are some clients clamoring for? What are some clients clamoring for right now? They want to be in the market. Why? Look what it did for last year. Look what it did for last year. Is now the time to be in the market, or saying thank you very much? Yeah, fear of missing out. Is now about time to be in the market, or the time to be readjusting your portfolios again to balance it to a FIA 50% and equities 50%? Because remember, even with this at that 1.1% rate of return over the next 10 years, what will give you a great rate of return at a 1.1% over the next 10 years? An FIA will. Why? Because is it going to be 1.1% every single year for the next 10 years? Or is it going to be up and it's going to be down? And what performs best when the market's up and down? That's right. That's right. Does that make sense? So guys, just a reminder, let's be cautious with what's going on right now. So now to the fun part. Now to the fun part of the call. The American College did and they do this annually, a retirement literacy quiz and it stumped 8 out of 10 consumers that took it. And these were not dumb consumers. I'm going to show you the demographics of people that took this. According to the college's 2020 Retirement Income Literacy Survey, only a handful of Americans are considering all the factors necessary to ensure a secure retirement and have financial know-how to make it a reality. With only 19% of participants passing the 38-question quiz, the survey shows a need for greater understanding of assets, long-term care, and other elements in retirement planning. Researchers conducted an online, we're going to actually take this test here in a second. Researchers conducted the online interviews this last spring with 1,500 Americans aged 50 to 75. Is this our target market, guys? Is this our target market? Yes, it is. Having at least $100,000 in household assets, not including their primary homes. To pass, participants had to answer at least 23 questions or get a 60.5 correctly, but the average score was 42%. Previously, the study ran in 2014, 2017. I'm sorry, they don't do it every year. They do it apparently every 3 years, producing similar results. And these are the people that took this quiz. So we got, this is their income. So over 150, 24%, 100 to 150, 30%. I mean, are these people that we want to be talking to? This is the people we want to be talking to. So let's see, and this is something you guys could actually use for, and we'll talk about that a little bit at the end, for your clients or prospects. You can actually have people take this quiz online with you. So that's what we're going to do today. So you see here, if you just Google the American College 2020 Retirement Income Literacy Survey, or you can see the link down here, but it's very easy to find. It'll bring you to the quiz. So we're going to actually take the quiz as a group, 38 questions, and we'll see how we as a group can do. I've already done it. I got 3 wrong, none to do with investing, 1 to do with sad to say annuities, and then 2 to do with longevity statistics. So which gave me a 91.7% accuracy. So we're going to take it as a group, though, to see how we do as a group. So here we go. Bring us here. Oh, I got to bring it up here. Okay. Can everybody see that? Can you see that, Missy?
I sure can. Looks good.
Okay. Okay. So we're going to go through each of these and answer these. So I'm going to be asking you, and just put in A, B, C, D, and we'll go with the one that most, with the answer that it seems like most people are giving, okay? And we'll see how we do on this quiz. So number 1, choose the response below that best completes this statement. If you had a well-diversified portfolio of 50% stocks and 50% bonds that was worth $100,000 at retirement, based on historical returns in the United States, the most you can afford to withdraw from each year is about blank, plus inflation each year to have a 95% chance that your assets will last for 30 years. Is it 2,000 out of 100,000, 4,000, 6,000, 8,000, or I don't know. So everybody's getting this one. Yep, everybody's getting it. It's 4,000. So choose the response below that best completes this statement. To maximize the safe withdrawal rate from a portfolio over a 30-year retirement period, it is best to hold what percentage in equities throughout retirement? Should we have 0 to 10%, 25 to 35%, 50 to 60%, 90 to 100%. Okay, you're going to have to help me, Missy. It looks like we're getting B's and C's, B's and C's.
Yep.
Looks like more C's than B's, you think?
Yep, I would say C's.
Yeah. So it's almost completely half and half, but we're going to go with C because it looks like it's slightly more in the 50 to 60. Okay. True or false, taking a portion, 20 to 40% of retirement portfolio and buying a life annuity can protect against the uncertainty of life expectancy, ensuring that a basic level of spending is available throughout retirement. Is that true or false? Everybody's saying true. That's a complete agreement on that one. 4, a 25% negative single year, a negative single year return in a retirement portfolio would have the biggest impact on long-term retirement security if it occurs 15 years prior to retirement, at retirement, 15 years after retirement. Timing doesn't matter, I don't know. What's the answer to that? Everybody's getting that one. B, that's the sequence of returns risk. Which of the following strategies is least likely to improve retirement security? Working for 2 years past the planned retirement date, deferring Social Security benefits for 2 years longer than the 25 originally planned, save an additional 3% in the 5 years prior to retirement, or I don't know. Which is the least likely to improve retirement security? Did everybody already give me those, Missy? We're getting A's and we're getting
saving,
C's.
so the C one, so saving an additional 3%.
So yeah, we're getting A's and C's, but it seems like a little bit more in the C's.
Yep.
Okay, now how long will you live life expectancy? A 65-year-old man has an average life expectancy of approximately an additional how many years? So not from 0, not from birth to death, but from 65 to death. What is the average 65-year-old going to live to? Another 10 years, 15 years, 20 years, 25, 30? How many? Wow, we're getting all over the place on this one.
Yeah, it's kind of all over the place. I guess I would say that it looks like C.
C seems to be a little bit heavier.
Yeah, maybe slightly heavier.
Huh?
20, yeah, I would say
it looks
20.
like C's.
Heavier.
Yeah, we're getting all over. We're getting from 10, 15, 20, 25, and I don't know, but it looks like more C's than anything. So we're going to go with C. Which of the following is true about cash value life insurance? The policy will typically cost less than a term policy. You typically cannot borrow from the cash value. The policy will expire after a specific period of time. The cash value portion will accumulate tax deferred. Which of the following is true about cash value life insurance? Everybody's getting it E, okay? True or false? The death benefit from a life insurance policy owned by an individual is income tax free for the beneficiary. Hope we all get this one. Okay. The lifetime income payout rate, the annual annuity payment as a percentage of the purchase price for an immediate income annuity for a 65-year-old male today is roughly 3 to 4%, 6 to 7%, 10 to 12, 14 to 15. Getting a lot of A's, a few B's. Looks like most people are picking the A's.
A's, yep.
So a few B's, but most people are picking A's. Okay. An immediate income annuity that pays an income of $1,000 a month is generally going to be more expensive the younger the owner is when they buy the annuity, or when the annuity begins, I'm sorry, for a man rather than a woman, if interest rates rise, or for a single person more than a couple. So an immediate annuity that pays $1,000 a month is generally going to be more expensive for which one of these? A, B, C, or D? Everybody's getting this one. A. A deferred variable annuity with guaranteed lifetime withdrawal benefits can pay income even if the investment goes to zero, ensures that the investment account will not lose value, only offers investment alternatives with fixed returns, pays guaranteed income that varies based on market performance. So which one? Oh, we're getting all over the place. But most people are saying A. Oh, we're getting B's and D's. So we're getting all over the place on this one, but it seems like most people are saying A.
A.
So that's what we'll go with, though we have lots of different answers there. Go to the next page here. Although a minimum distribution will not be required in 2020, distributions from an IRA generally must be made every year once the individual has attained the age of what? 55, 59 and a half, 65, 70 and a half, or 72. Surprisingly, we're getting 70 and 7 and a half. It looks like a even split. In fact, more people are saying 72 than 70 and a half, so that's what we're going to go with. So some people said 7 and a half, more people said 72. Which of the following statements concerning the federal income tax treatment of distribution to a 65-year-old retiree is true? Distributions from a traditional IRA for the 65-year-old are generally subject to an additional 10% penalty. Distributions from a traditional IRA are generally taxed as long-term gains, or distributions from a Roth IRA are generally tax-free. Yeah, everybody's getting this one. Roth. True or false? A retiree who is working part-time can generally continue to contribute to an IRA or Roth IRA. True or false? Everybody's saying true. Converting a portion of your traditional IRA into a Roth IRA is a good idea this year if you have a big tax deduction this year and your marginal tax rate is lower than normal. You have more taxable income than usual and your marginal tax rate is higher than normal. The value of assets in your IRA have remained the same for 10 years. Which one of those? Everybody's saying A. Suppose that the interest rate on your savings account was 2% per year and inflation was 4% a year. After 1 year, would you be able to buy more than, exactly the same as, or less than today with the money that's in that account? More than, exactly the same, or less than? Everybody's saying C.
C.
Of the following options, the best way to protect against inflation is to have a diversified portfolio of traditional bonds, a diversified portfolio of stocks, or a diversified portfolio of CDs. Everybody's saying B. They didn't have the right answer, though, did they? What's the right answer? 50-50, that's exactly right. Housing and retirement. Sarah is single, age 65, and takes a reverse mortgage with a lump sum payment. When does the loan have to be repaid? Whenever the mortgage company wants it back, when she takes it on any other loan, when she attains the age of 75, or when she permanently leaves the home. Everybody's getting that. It's D. Continuing care retirement communities are different than 55-plus housing developments in that CCRCs always offer a range of care from independent all the way to nursing care, the opportunity to participate in social events, or the opportunity to relatives to be on the grounds. Everybody's getting that. A. Medicare planning. Traditional Medicare will cover which of the following medical expenses? Routine dental care, physical exams, hearing aids, or all of the above? Ooh, we're getting all sorts of answers on this. People are saying A, and people are saying B and C. More people are saying, though, B. So we're going to go with B. True or false, Medicare supplement insurance policies are most commonly purchased to cover deductible and copays that are charged under Medicare Parts A and B. True or false? Everybody's saying true.
True.
True or false, the total out-of-pocket medical cost for married couples in retirement is relatively consistent from retiree to retiree. True or false? False. Everybody's saying B. What is the proportion of the population that is going to need assistance with activities of daily living at some point, or they're going to need long-term care at some point? I got this one wrong. Getting a lot of D's and a lot of C's. Looks like they're going more towards the D's.
Yeah, D1 out.
Okay. Nationally, who pays for the majority of long-term care expenses provided in nursing homes? Medicaid, I got this one wrong too. These are the two of the three that I got wrong. Medicaid, insurance purchased by individuals, private payments by individuals, or Medicare. Which one? We're getting A, we're getting C's, we're getting A's, C's, a few D's, but most people are saying A. Would you agree with that, Missy?
I would say A is heavier.
Majority. Yep. Nationally, who provides the majority of long-term care services? Assisted care living facilities, hospitals, family members, or nursing homes? We're getting a lot of D's, and we're getting B's, and we're getting D's and B's. Pretty easily. Boy, that's right split down the middle.
Yeah.
D's and B's.
I'm thinking it looks like D, maybe one out just
Okay,
a little bit.
Okay, we'll go with D then. Long-term care insurance is intended to cover emergency room care, hospital expenses after surgery, Alzheimer's care, or all of the above. Everybody's saying D. True or false? Medicare typically pays for the cost of a nursing home for the first year. Everybody's getting that one. False. True or false? Buying a single company stock usually provides a safer return than the stock mutual fund. Yeah, everybody's getting that. That's easy. 100% of mutual fund assets are invested in long-term bonds, and the investment climate changes so that the interest rates rise significantly. Then the value of the mutual fund shares increase, decrease, will not change at all, may rise or fall depending on the. I hope you guys get this one. Yeah, decrease significantly. Historically, which of the following generates the highest returns over a long period? Dividend-paying stocks, or stock funds, high-yield bonds, large company stocks, small company stocks. Which one? Getting B's, F's, E's, D's. Boy, we're all across the board there.
I would say B looks like it's heavier.
Now we're getting, it looks like now some more coming in with the E's are heavier. D's. They're all over the place. So what do we got? Yeah, I'm going to go with E. It looks like most people are saying E.
E. Okay.
Barely, because we got D's and E's are evenly split. And then we got a few B's in there too. True or false? Exchange-traded funds generally have a higher expenses than actively managed funds. Everybody gets that. A PE ratio means par value to earnings, price to expense, profits to expense. Everybody's getting that. Which of the following types of long-term bonds typically has the highest yield? AAA corporates, treasury bonds, or B-rated corporates? Everybody's getting that. Social Security. A single person who is likely to live to age 90 is generally going to be better off claiming Social Security benefits at age 62, 66, 70, or 75. Everybody's saying 70. Few people are saying A. Most people are saying those C. Social Security workers' monthly benefits are increased for each year that the benefits are deferred from age 62 to age what? 65, 66, 70, 75. Everybody saying C? Please choose the response below that best completes the statement. According to the Social Security Administration, around 2033, they will only have funds to pay for approximately what percentage of promised benefits? We're getting A's, B's. Oh, we're all over the board on this one.
All over.
Wow, we're all over from
Yeah,
zero. It looks like A, B, C, D, all over the place. A lot of C's. It looks like more people.
C's.
What would you say at this point?
I
Wow,
think
it's
I would
almost
say
evenly.
it's pretty evenly split amongst all four of those. Maybe C. So quite a few C's at the
Okay.
beginning.
Okay, so we'll say, yeah, all man. There's a lot of all those answers, but it looks like C's are slightly ahead there. Company retirement plans. If a participant is given the choice of a lump sum or a life annuity from a company-sponsored 401k retirement plan, the life annuity is likely to be the better choice if the participant is most concerned about leaving money to children, having enough money for basic expenses, having flexibility to meet changing income needs, or getting an increasing stream of income over retirement. Which one? Getting D's and B's, but it looks like the B is
B.
winning.
Yep.
A lot of D's and a lot of B's. It looks like B won there. If a large public company sponsoring a 401k plan files for bankruptcy, employees are A, at risk of losing their 401k benefits because the trust assets will pay creditors first, or at no risk of losing 401k benefits because the plan is outside the claims of creditors. Only at risk of losing 401k benefits if the plan document says the creditors have the right to their trust assets, or only at risk of losing their 401k benefits if a judge decides the creditors should be paid first. Everybody's saying B.
It's like B.
Yep. So let's see how we did as a group here. 97% right. That's pretty darn good. So, number one, 4,000 is the right answer. How much can you pull out over the 100,000? With 100,000, 4% with 95% chance. Though, is that completely accurate with all the other research that's been done lately? No. Yeah, it's not because, and are most people saying you could pull out more, or most people saying you could pull out less? Less. Now, here's a trivia that I found. I totally disagree with, but I found here about 2 weeks ago. The gentleman who came up with the 4%, obviously he was a financial advisor back in the 90s. He came up with that 4%. He's now saying it's inaccurate. And what is that guy saying? We can pull out more or less. You guys are so smart. Well, it was about half and half. He's saying more. He's saying more because inflation has been so low. Yeah, I agree. Inflation's been so low, but what else is low right now? Interest rates. Because that 4% was based on a decent interest rate and bonds going up in value. What's the chance of bonds going up in value over the next significantly? Because remember, we had a whole decade where bonds did better than stocks. Is that going to be happening over the next 2 or 3 decades? No. So most entities like FO, KITS's, and the others are saying 4% or less than 4%. Less than 4%. Number two, to maximize the safe withdrawal rate of a portfolio over a 30-year retirement period, it's best to hold 50 to 60. Now, here's the weird thing. When I took this test, I said 50 to 60. And it told me that I got it wrong, that it's actually 25 to 35%. So you see, they both are grayed out here as being the right answer. So what is that telling you? When they said both 25 to 35% the right answer and 50 to 60%. So really, I only got 2 wrong because this is the third one I got wrong. I said 50 to 60, and for some reason the quiz told me I had it wrong, and it told me that the 25, 30% was right. Now, Missy and Jeff took it, and it came up like this, just like for us, that it's saying both of these are right. So I don't know what happened to mine. But so what is it saying? Why is it saying 25 to 35% is right and 50 to 60% is right? Tom's got it. Because it depends on the 30-year period. Now, going forward in the 30 to 40 period, what do you think the likelihood is? 25, 35% or 50 to 60%? Yeah, 25 to 35. But Anywhere between 60 and 25% is the right answer. So we're right in the sweet spot with that 40 or 50% in the market. Yes, that's where our client should be. True or false? Person taking 20 to 40% retirement portfolio and buying a life annuity. We all got that right. We all said true on that one. That was pretty easy for everybody. A 25% negative single-year return. We got that right. That's sequence of return risk. Which of the following strategies is least likely to improve retirement security? There was quite a bit different answers to this, but the correct answer was saving an additional 3% of salary in the 5 years prior to retirement is going to make very little difference in whether you're going to have a good retirement or not. Working longer, that's going to have a significant account, and waiting for retirement benefits is going to have a significant chance of increasing your improving your retirement. So the 3% extra the last 5 years isn't really going to make much of a point. 3% additional at age 20 going to make a huge difference. But guys, in the last 5 years, that's going to make a big difference. Age 20, huge difference. Last 5 years, no difference. A 65-year-old man with an average life expectancy of approximately additional what? 20 years. So a 65-year-old man is likely to live to age 85. A newborn in today's world is likely to live to age what? A newborn born today is likely to a newborn male, life expectancy, depends on who you're talking about. Life expectancy right now from 0, now there is some data where people are projecting that a newborn would live to age 90, but that's projection. What are the current statistics of somebody, newborns from 0, of all the people living right now, 0 to expected life expectancy in the U.S.? What is it for a male? 73 years. 73 years. But if you've made it to age 65, that means because that age 73 says, do some people die between 0 and 65? Yes, they do. But when you take those people out, because that's people dying at birth and all the other things. If you've made it to 65, life expectancy is no longer 73. That's from 0 to life expectancy. Life expectancy when you make 65 is age 85. So we should be planning for our clients. They should be planning for how long a retirement. This is average. This is average. So they should be planning for what? Well over 20, right? Well over 20, because this is average. That means between 65 and 85, half the people die, and half the people what? Live longer. So they should be planning for 90, 95. Does that make sense? Which of the following is true about cash value life insurance? The cash value portion will accumulate tax deferred. We all got that right. True or false? Death benefit from a life insurance policy. We all got that right. It's tax free to the beneficiary. In an immediate income annuity that pays $1,000 a month is generally going to be more expensive. We all got that right for the younger person. A deferred variable annuity with guaranteed lifetime withdrawal benefits can pay income even if the investment account goes to 0. I think all of us got that one right. Although a minimum distribution will not be required in 2020, distribution from an IRA generally must be made every year. Now, we had different people saying different things here. So it's 70.5 or 72 depending on. 70.5 to 72 depending on. And that's a whole can of worms to open up on why both of those are the right answers. So some people were saying 70.5, some people were saying 72, and you were both what? Right. Which of the following statements concerning the federal income tax treatment of distribution of 65-year-old retirees is true? Everybody got this one. It's the Roth is tax-free. True or false? A retiree who is working part-time can generally continue to contribute to an IRA. Everybody said true. That was right. Converting a portion of a traditional IRA into a Roth IRA is a good idea this year if you have a big tax deduction this year and your marginal tax rate is low, because obviously it's going to be a taxable event, so you want to be in as low a tax bracket as possible. Suppose the interest rate on your savings account was 2% per year and inflation was 4%, we all got that right. You'd have less today because obviously inflation is going up faster than your return. Of the following options, the best way to protect against inflation, we all said diversified portfolio stocks. That was universal. We all got that right. Sarah is single, 65, takes a reverse mortgage. We all got that one right. She's not going to be taxed on that, or when is, I'm sorry, not taxed, but the loan doesn't need to be repaid until she permanently leaves or sells the home, or I guess leaves the home, because if she goes in, they're going to force a sell if she goes to a nursing home, etc. Continuing care retirement communities, a range of care from independent living to nursing care. We all got that right. So this one we had a lot of different answers on. Traditional Medicare will cover which of the following medical expenses? We had all sorts of answers on this, but the correct answer is physical exams. Traditional Medicare will not cover dental. It will not cover hearing aids. It's not going to cover glasses, but it does cover physical exams. True or false? Medicare supplement insurance, we all got that one true. It's used to cover the deductibles, copays that are charged under A and B. True or false? The total out-of-pocket medical costs for married couples and retirees are relatively same. We all got that one. That's false. It can vary drastically. What is the proportion of the population is going to need assistance with activities of daily living? 70%. I said 50%. 70% is going to need some level of long-term care. Does that mean they're going to be in there for 5 years, or that just means some people are going to break a hip and need it for a month? So when you include all those, because I went and researched this, and the percentage that are going to need it for 3 years or more, is that 70%, or is that significantly less than that? Yeah, it's much less than that. But 70% are going to need some long-term care needs during their lifetime. Nationally, who pays for the majority of long-term care expenses? We had all the answers all over all over the place on this one. The correct answer is Medicaid. Nationally, who pays for the majority of long-term care expenses provided in nursing homes? Medicaid does, because that's people who have Alzheimer's are going to be there for how many years, and it's going to cost how much money. So even though percentage-wise, most people cover it themselves, payment from private individuals. Most people will be this, but the fewer people have bigger or lower bills. Bigger bills. Nationally, who provides the majority of long-term care services? Family members. Most people said family members, and they're right. Long-term care insurance is tended to cover what? Of all these, it's the only one that's going to cover is Alzheimer's. That's why we have it for those long stays at $9,000 a month, as somebody pointed out here. True or false? Medicare typically pays for the cost of a nursing home care. We all know that that's false. True or false? Buying a single company stock, and we all got this one. These are pretty easy. False. That's not going to give you more safety. If 100% of mutual funds assets are invested in long-term bonds, and an investment climate changes to, we all got that one right. If you're in bonds, interests go up, bonds are going to go down, and mutual funds are worse than individual bonds. Historically, which of the following generates the highest returns over a long period of time? Small company stocks do. Small company stocks. They also have the most what? Risk. The other problem with small company stocks, do small company ETFs work, guys? They do not work. So if you do any research, small company ETFs do not mirror the Russell 4000. They can't, for whatever, there's a long explanation for why they don't mirror. The S&P indexes work fantastic. The Dow indexes work fantastic. Even the middle mid-sized stocks work pretty well when it comes to ETFs, but small company ETFs do not work for a number of different, there's too many losers in there. That's one of the main reasons, David. So that's a difficult thing for people to utilize. You're almost going to have to use an actively managed stock fund to do that. And when you get into an actively managed stock fund, how many active managers beat the index? So the Russell 4000 does fantastic over time, has a lot more volatility, can go for 8 years where it doesn't perform very well at all, and then all of a sudden it has 5 or 3 or 2 unbelievable years. But when you use an active manager, that there's no guarantee they're going to mimic how well that index does. True or false? Exchange traded funds generally have higher expenses. We know that's false. PE, we got that one. Price earnings ratio. Which of the following types of long-term bonds, we all know B-rated bonds, are going to give you the highest interest rate? A single person who's likely to live to age 90 is generally going to be better off claiming Social Security age at what age? We got some different answers on this one. We had 62, 70, 75. 70. Why at 70? Why at 70, guys? What does Social Security quit doing at 70? Yeah, it's not. They're not going to. The payment doesn't increase at that point. The increase stops. Social Security workers, monthly benefits are increased for each year that the benefits are deferred from age 62 to what age? We had some answers all over here. 70. According to the Social Security Administration, around 2033, they will only have funds to pay for approximately 75% of promised benefits. So what's going to happen in 2033? I have no clue. And we covered this here in a coaching call a month and a half or so back. We have no clue what's going to happen with that. They can do all sorts of things to make that happen. They could change they could slide out from age 67 to age 68 to 69. The retirement age, full retirement age, they could the chance of them only cutting benefits to 75% is not high, but if they do nothing, what will they be forced to do? They're going to have to cut because there's no money there. So we don't know what's going to happen, but that's worst case scenario at that point. If a participant is given the choice, well, let's go back to here a second. So what does that mean for when you should start your Social Security then? Is it really cut? Yeah, so I would say sooner, maybe sooner, because at least they're going to lock in. They're not going to lessen somebody. You might as well get as much as you can right now. So even the Social Security benefits software, is it incorporating this danger right now? So, as with anything, when we talk about the future, is there a clear black and white answer? No. So make sure people understand all the different things that can happen here. If a participant is given the choice of a lump sum or life annuity from a company-sponsored 401k plan, the life annuity is likely to have enough money. That's not going to leave more money to children. It's not going to give you an increasing stream of income over retirement. It's having enough money to meet basic expenses. That's the main reason it's going to work. If a large company sponsored 401k, files for bankruptcy, we got this right, at no risk, there are no risks because the 401ks are separate. So how can we use this, guys? First of all, was this kind of fun for you to go through? It was fun for me to go through. So wouldn't this be a fun thing to go through with your clients on a webinar? Wouldn't it be a fun thing to go through with prospects, invite them as well? And could you get into lots of conversations, and could it maybe shake the tree and find some money with these things? So I would, as you can see, is it possible to go through this quiz online with clients? We did it together today. It was not too difficult. Just have to look at the answer to the questions. You're able to do it. So I think this is people love taking quizzes. They like to figure out where their knowledge is. They like to learn new things. And when you do it more of a informal, where they don't have to take the quiz and admit that they did things wrong, they're even more involved. I mean, if you think about Jeopardy, Wheel of Fortune game shows, how many people watch those things? And it ain't the millennials watching them. Who's watching them, guys? Our target market is watching them. Does that make sense? So think about inviting people to a webinar, doing this. And if it's clients, have them invite their parents or have them invite their neighbors or their friends or their brothers or their sisters to go through it. It's a fun thing to do. You can give out prizes. You can give out gift certificates. And in December, it's a great time to do it. And people are not going to be traveling as much, or a lot of people aren't going to be traveling much and things like that. So December is a good time to do something like this, okay? Coolio. Well, that's what I had to cover today. Hopefully you found it enlightening and maybe giving you a few ideas on how to maybe shake that tree during the holiday season. And with that said, I will let you guys take off here, and you guys have a fantastic rest of the week, and we'll talk to you next Monday. Thanks, everybody.